Well, welcome. Good morning, everybody, and welcome to the Compliance Stream Forum here at Cybers. My name is Kavita Maharaj, and I'm going to be moderating all of the sessions in this room in the next couple of days. So nice to have you with us. In this session, we are discussing counter-terrorist financing, and we're asking the question, are we really stopping the bad guys? Now, we have 60 minutes for this discussion, and members, we know we have members of the audience with varying different degrees of knowledge. So the approach that we usually take in these sessions is to try to strike a balance between educating and also having a great debate on some of the issues. Without further ado, let me introduce our panel. As they were saying, they all feel like rock stars. I'm sure, as Alan was saying, but rock stars can't do what they do. Well, let's see. First, we've got Alan Ketley. He's on my left here. He is the MD, AML Strategy, the Global Strategy Group of the Bank of Tokyo Mitsubishi. Next to him is Stephen Alsace. He's the Senior Director at AML and Sanctions at CIBC. And Mark is, last but not least, Chief Compliance Officer and member of the Executive Board and Director of Clearstream. Now, I must apologize to you because we did have another person on the billing, which was David Lewis. He's the Executive Secretary at FATF, the Financial Action Task Force. Unfortunately, due to an urgent work commitment, he could not be with us today. So I'm very sorry that he couldn't make it. And obviously, it was very, very late notice, so we couldn't enact or get someone else, another victim. So welcome to all of you. Let's give them a warm round of applause, everybody. So the first thing I want to do is just go through the structure of what I want to do over the next 60 minutes. I think we want to spend a little time, just a few minutes, on the scale of the problem, the number of attacks that we've seen, the types of attacks, terrorist attacks that we've seen that really have changed from what we've seen in the last couple of years. And of course, because of those changes in attacks, that has then changed the way these attacks have been financed. So that's the first area we want to discuss. Then I want to spend a few minutes on what regulations have been put in place on the international, on the national, and the regional levels to deal with counterterrorism financing, talk about what new expectations, if any, regulators have regarding financial institutions being on the front line of CTF controls. And then for the lion's share of our discussion, thirdly, I want to focus on what does this all mean for banks, for financial institutions. Terror financing obviously is changing. How are banks keeping pace with this and adapting all of their processes to keep up? And specifically, what kind of new actions are they taking to make sure that they comply with all of these AML and CTF regulations? And then finally, fourthly, I want to just touch on, the question, are we actually stopping the bad guys? So let's kick things off with point number one, talk about, I believe that, ask anybody, and I'm a Londoner, so I know we've certainly seen more attacks. The types of attacks have changed. They've gone from bigger attacks, which probably cost more money, to these sort of small cell, lone wolf attacks, less money, very difficult for a bank, for example, to see whether that's a suspicious activity. If somebody is going into a vehicle rental company, renting a van to then go and kill lots of people, that doesn't seem suspicious because we all go into vehicle rental companies. And how does a bank know whether that person is going to carry out an attack? And so what you're seeing is attacks are being funded in a different way. They've moved from being funded by illegitimate means to now more legitimate means because there's not that much money involved in carrying out an attack. So people are using, whether they're getting loans from family or friends, whether they're, doing short-term employment to get wages to then go and carry out attacks, or they're using state benefits, student loans or employment benefit, etc., to then get this money to then carry out attacks. So I just wanted to get your views on the scale of the problem that we're seeing and how different is it today than in the last couple of years?
I guess we've now weaponized the man with the white van. And I wonder if we dare think that we might have been successful and that this is one of the consequences. I think there's a Chinese saying that today's rooster is tomorrow's feather duster. So the last thing we want to do is say, yeah, we've been successful because in 15 minutes' time something bad will happen. But I think terrorist financing has generally been the mix of good money and bad money being used for bad things. As the amount of money necessary to do the bad things has declined, our terrorists are sort of hiding in plain sight. How do you figure out which car rental is the problem? And I think we saw in Nice, it wasn't even a car rental. Somebody stole the truck.
Yeah. Stephen?
I'm actually going to preface my comments to say these are my personal views and not from my employer. But I agree very much with what Alan is saying. I mean, I think the traditional form of money laundering or terrorist activities on a large scale, that hasn't disappeared. I think that's still prevalent in what we have to deal with day to day. I think what we're seeing now, though, is more of the individual lone wolf type of actions, and they are incredibly difficult to spot. We talked about weaponizing a van. It doesn't necessarily mean a van or a vehicle. It could be a knife. It could be anything. What we've seen, what I've seen personally, you have to be careful about, chasing down every potential false lead. Like if you start looking at, any kind of automation of rules or triggers, and you look at some of the factors that you'd have to identify, i.e. vehicle rentals, I mean, your false positive rate just goes through the roof, and you just don't have the people power to be able to process all of those false triggers. So you just have to be very careful and go about this in a quasi-intelligent manner where you can. But it's challenging. It's very difficult to accomplish in practical reality.
Yeah, from where I sit, it's an odd question. We deal with cross-border securities, with the international infrastructure of how securities are held across the world, including by offshore centers and so forth. And, the prevalence of what we see directly in the terrorist financing space is not zero, but very low. Primary concerns are sanctions and high value, very high value money laundering. And it's that latter point where there's an intersection. And, I agree with you that your high value financing hasn't gone away. Clearly, the fact that the lone wolf attack has become so prevalent that if you like, the cost of mobilizing your average, or the average cost of mobilizing an attack recently has fallen dramatically. It's now in the range of tens or hundreds of dollars, not tens of thousands or hundreds of thousands of dollars.
And most branches, they actually look at transactions more closely of $10,000 and above. So a lot of these transactions are happening even under the radar of most branch managers anyway.
Well, that's one of the challenges we faced, right? You have your traditional money laundering rules that are in place that detect the larger scale financing. You're looking at the thresholds, like $10,000 or even shortly close to that. You're looking at the layering, structuring. You're looking at high velocity, your traditional money laundering indicators. Unfortunately, these lone wolf financing, they fall well below any of those traditional indicators that you have. So then you're left with, okay, trying to come up with a typology of what you think is a potential lone wolf, but the problem is it's so varied, and the criteria is it's vast. And you look at that, you're not, in some cases, it's not even associated with any kind of illegal or activity, and that's where it becomes very problematic.
I think we run the risk of confusing two things, though. I mean, the $10,000 is a reporting threshold. We have anti-money laundering rules that look at normal behavior for customer activity. If somebody's income is $3,000 a month, and they do something for $2,000, that would probably be unusual for them and would warrant investigation.
Okay.
So $10,000 is what has to go to the government, but that doesn't mean that that's all that we look at.
Okay. I want to get to the second area, which is regulation. There have been a lot since 9/11, really, all of these regulations been a major priority for both governments and banks to deal with counter-terrorist financing. What are the expectations of regulators, would you say now, regarding banks being on the front line of CTF controls? And have those changed in any way as we've seen more and more attacks happen?
So in the AML space in the US, there hasn't been a great deal of change. There are new regulations around beneficial ownership for companies. But I think FinCEN, the Financial Intelligence Unit in the US, has got a lot more creative with the way it uses the existing regulations to do much more targeted analysis of activity and requiring banks to provide very specialized reporting. It's sort of a catch-22 in some ways. The more you talk about it, the more gets reported about it, so the more the bad guys can read about it. There's a lot of interest, genuine interest in, show me a typology that I can monitor for. Show me something that is an objective indication of some bad activity, and I'll monitor the hell out of it. You know what? As soon as that's made public, the smart bad guys are going to change their behavior.
Yeah.
I'm in agreement with Alan. 9/11 was the threshold event that's precipitated a huge raft of anti-money laundering, anti-terrorist financing type of legislation. In Canada, we have the Anti-Terrorist Act that came shortly after 9/11. There have been some recent, attempts to, bolster information sharing, and that's been the critical piece, right? And I think since that event, we've seen the importance of financial institutions, and we do this voluntarily. I mean, we want to be good corporate citizens, and going beyond just what is our regulatory requirements in sharing information, in filing SARs, STRs, but also in speaking to we'll call it law enforcement, federal law enforcement. In Canada, under the Bank Act, we have the ability under BCPIO to actually share information that relates to fraud, or if it's in the interest of national security with law enforcement. You don't need a warrant or other production orders to be served on the banks to be able to share that information. Recently, with Bill C-51, there were attempts made by the intelligence community, the Canadian Security Intelligence Service, to actually bolster the abilities and powers of CSIS to collect information and also intervene. Well, that legislation passed. They now have an intervention power, but the power to be able to collect information from public sources was drastically watered down. And it was largely because of lobbying that occurred from privacy advocates. And that's why we find that you've got this conflict that exists constantly. So from a security perspective, it's good to share information as much as possible, internationally as well as domestically. We've seen that with attacks like Charlie Hebdo, et cetera. But we're constrained by domestic legislation and privacy rights. And the problem is that they don't necessarily go hand in hand, right? You can't have both. You can't have absolute protection of privacy and be able to collect information to be able to prevent attacks, at least in my view.
I think if we take a step back from the problem, realistically, expecting banks to identify bad sources of funding, or rather good sources of funding that are likely in future to be applied badly, especially low-value operations, is unrealistic and is unlikely from a public policy perspective that it's sufficient to concentrate on banking as opposed to retail, for example, the sale of the tools. But where regulation is moving forward, I think, in a positive way, albeit slowly, is on two fronts. If we look in Europe, then the fourth money laundering directive emphasizes or seeks to emphasize a more risk-based approach. That is to say, tailoring the way in which you apply the regulations more on a risk-led than a rules-led basis, although it's still very predominantly quite prescriptive. And the second part is information sharing within firms, but information sharing also between the public and private sector. And certainly, I would argue for more feedback from the public authorities. All too often, transaction reports just disappear into a void, and you've no idea as a filing bank what happened. Was that intelligence useful? Was it not useful? You often have the impression, possibly quite unjustly, that it's just sat in a dusty bureaucratic pile somewhere and is not actioned. But if we go to the typology of what we've been talking about, the lone wolf attacks and so forth, clearly what is of most utility from a public policy perspective is afterwards, with hindsight. What is it that went into this individual's particular behavior? What was his or her use of the financial system in the formative steps of that attack? Is there use in, or is there more use, not in prevention, but in using the banks to observe people who are suspect and to work with the banks in order to build intelligence? It seems to me that with low-value attacks, that there's likely to be much more utility in those areas than simply in saying, you know, thou shalt not permit an $80 payment for a van rental.
I think traditionally we've, as an industry, done really well when we're given something very specific to look at. Alan Ketley did something bad. Let's take a look at his bank accounts for the last 3 months, 6 months, 12 months, and see exactly what he did. One of the challenges, though, from the bank's perspective is I may have the best monitoring system in the world, and for the record, I don't, but I can only monitor what I see. So if this bad guy, Alan Ketley, has accounts at multiple banks, unless he's revealed that activity to me by doing a transfer between his account with me to his account with someone else, I can't see it. And for me, that's an argument in favor of more information sharing and the ability to work proactively with other banks. We see that evolving in the UK with the Gimlet initiative, and we see a lot of talk about it in the US as well.
And that was one of my earlier points. I mean, that's the challenge that we have, is information sharing, even in North America. Like from a domestic bank perspective here in Canada, we're very limited on what information we can share with our peer banks. And in Canada is an interesting example because we only have like 6 big banks that represent probably 85 to 90% of transactions, right? So if we had the ability to share that information, it would be more valuable not just to the participant banks, to be able to chase down other leads. I mean, to your point, if you have a name, if you have some information you can start with, it helps. Now, today, we file suspicious transaction reports, and we file those with the RCMP. The banks also now have access to deliver this information to CSIS directly. We understand there's still constraints within the domestic sphere between interagencies being able to share this information on a timely basis. And that's one of the criticisms we receive from law enforcement repeatedly, is that they themselves internally do not have the mechanism to, on a rapid basis, be able to share that information, especially where there's a threat. It's a bit ironic, in some of the recent attacks, some of the tips came from outside of Canada, like to be able to push the RCMP forward. They came from the FBI. They didn't come from CSIS.
So what can banks and financial institutions now do in terms of adapting the processes that they've already put in place? Because, I mean, clearly they're spending a lot of money, billions of dollars. I think I read somewhere that just in the last 10 years or so, most banks have tripled their compliance staff. If you look at the money that's spent on governance, risk, and compliance in a bank, it's now about 15 to 20% of the bank, of the cost of running the entire bank. So it's not that they're not doing anything, they're spending a lot of money. When I was trying to prepare for this panel, I sort of thought, oh, let me just try and make a small list. It ended up being a big list of what are the kinds of things that banks have to do in order to comply with a lot of these regulations. I'm sure a lot of you know this, but just to make everybody on the same page, I mean, they're putting new systems in place for sharing information within and between institutions where they can. They need to capture, extract, and mine data from a variety of sources across the bank. They need to put in place effective KYC and CDD, the client due diligence technologies like biometrics and capture and touch ID. They need to look at their beneficial owner of accounts and unwrap those complex legal entities. They want to make sure that they maintain lists of PEPs, high-risk counterparties, high-risk countries, high-risk transactions, high-risk product types. I mean, it's a big list. They need to flag and assign risk scores or risk profiles based on risk assessments, CDD and KYC sanctions and watch lists. They need to maintain limits and transaction thresholds. They must record that transaction history. They need to raise red flags and alerts on defined parameters and triggers. They need to continually monitor and test their systems. That's what's costing a lot of money. I mean, the list goes on. I can,
Don't forget dealing with regulatory examinations from multiple jurisdictions as well.
So, all of these are what they have to do on a daily basis, whilst at the same time the goalposts keep moving. So how can they do all of this and solve the problem?
So this beats the hell out of me. I mean, this is all about a framework, and everything has to work within a framework. The challenge, I think, that bedevils us all is that gap between technical compliance and effective compliance. We can have well-written policies, well-written procedures, we can execute perfectly against them, but if we're looking over here and the bad stuff's happening over there, it's not very effective. I think to some extent all this becomes an exercise in hindsight. I used to work with somebody one of whose favorite expressions was experience is something you get when you got what you didn't want. Don't know about you guys, but we got a lot of experience. So you look for, okay, where did something fall apart? Where did we miss something? Where was there something from which we can learn? We read enforcement actions, we read news stories. Okay, that happened over there. Could it happen here? Do our people understand what they're doing? And it's a constant, refreshing battle. But I can be somewhat cynical about this as well. And I bring this very much down to my own personal life. I've known the woman I'm married to for nearly 40 years. Do I have a KYC file on her? Not really a file. Do I understand a profile of behavior? Absolutely. Can she still surprise me? Definitely. So the notion that as a bank, I can KYC any one of you, and that's going to give me insight into whether you're going to do anything unusual, which is going to help protect the financial system, I think in some ways is a little naive. But I think you have to layer that with a whole bunch of other things to make it work. So that's my cynical comment. Sorry.
I mean, you definitely have highlighted significant cost of compliance. And it's a good thing in the sense that banks play a very important role in society today. And I think that regulation to an extent is good as long as it's not overly prescriptive. And I think we've gotten to a point where perhaps some aspects of it are overly prescriptive. To Mark's point about Europe possibly revisiting a risk-based approach, I think is a smart thing to do. The challenge that we face, and I see this just looking at some of the exhibitors that are here, you're seeing a lot of innovation in products, but what's driving this innovation? Driving down costs. Like all companies, they would like to be able to complete transactions for their clients, and clients want payments for free. They don't want to have to pay any service charges for that. But the problem is, well, how do you cover these very significant costs of compliance, right? So in two ways, I see the cost being driven down through the use of robotics, through development of AI. I think that will be the future. I'm not going to speak to that. It's the other panel. But
Yeah.
Having said that, you're not going to eliminate people. You still will need significant numbers of individuals to actually review files, alerts. That's not going away, and that all comes with significant cost. We're heavily regulated in the banking industry. I mean, one of the things that the industry has been asking for is a level playing field. If you're a fintech and you're actually playing in this field and you're processing payments, you should be subject to the same standards as banks, and that's from a regulatory perspective.
Yeah, I do think that the frameworks that have resulted are a classic example of being penny wise and pound foolish. I think that we are only scratching the surface in many ways when it comes to what is high value, what is still going on out there. There has always been a kind of nexus where terrorism, where money laundering, where corruption and crime come together. And, you know, this morning I thought we should maybe pause and just think for a moment about Daphne Galizia, the Maltese journalist who was assassinated in a terrorist attack yesterday in Selima, for investigations associated with the Panama Papers and what that is, you know, what her son alleges is that she was assassinated for the transparency that she was bringing to the nexus between organized crime, tax evasion, and political corruption in Malta and elsewhere. And it is certainly true that for everything that the banks are doing, we remain, in my view, far too quick to rely on a thin veneer of legality to demonstrate that a given transaction, particularly high-value transactions, by which I mean hundreds of millions or billions, is perfectly okay, when your mother would probably tell you, no, that is not okay. And so long as we continue to define our obligations narrowly and systemically and ignore, if you like, the larger intent behind them, we will continue to fail. And terrorism has usually financed itself through crime. I mean, the idea of financing yourself through charity is also not new. The IRA was financed by charity, often in North America. A cousin of mine was blown up on the ramp to the car park of the House of Commons in 1979 with money financed in perfectly legal collections on the East Coast, primarily. So that's not new. What is also not new is financing terrorism through straight crime, through bank robbery. So the OAS financed itself, after the Algerian referendum in France in 1962. They financed themselves and financed the assassination attempts on de Gaulle through bank robberies. Today, and this is very much a theme of Sibos, we're focusing on cyber and the advanced persistent threat, where in effect state actors who are responding quite rationally to sanctions and the inability to finance themselves through trade are seeking to finance themselves through bank robbery, which we now call cyber vectors and surface attacks, but it is just bank robbery. And none of that can be effective if they cannot launder the proceeds. And here we talk about high-value proceeds. And therefore, our ability to do AML, not to survive an examination, but to actually prevent the misuse of our system, the system that we all here represent, is the last line of defense. And unfortunately, we would rather survive an AML examination with good marks than actually prevent that. And until our attitude changes, we remain at risk.
Very interesting point. And David, who could not be here from FATF, told me on the phone when we were chatting to prepare this panel, he said, what they really feel is that a lot of more valuable information to be had comes after the event, as you've been discussing, that you could not possibly know before an event. So given his comments and what you've just said, Mark, should we now be changing even the KPIs as to how you even measure success or how you should even do these examinations? So if you had to scrap the whole CTF system and start all over again, what would be the best model to have in place to effectively fight terrorist financing? That's one of the questions coming through from our audience.
So some of this is common sense, isn't it? How do you teach common sense, though? How do you assess in real time what is likely, with the benefit of hindsight, to look strange? I came into compliance from the sales and relationship management side, and 3 months after I was in my new role, desperately trying to figure out what the hell I was trying to do, my boss said to me, "So how are you doing?" I said, "I have no idea." She said, what do you mean? I said, I used to have a sales quota. I knew exactly where I was every day. Nobody went to jail today. We didn't get fined. We didn't fail an examination or an audit. How do we measure success in a way that is something other than the absence of failure?
Yeah, that tracks progress.
Yeah. So, I mean, we report. We do what the laws require us to do, and banks in the US and banks in the EU, between them, file around 2 million SARs every year. 1 million in the EU and 1 million in the US. Law enforcement will tell us that they want to keep receiving that, but I think the Europol information was that only 10 or 12% of the SARs in Europe were progressed for further work. So it comes back to technical compliance. We're doing what we're required to do. We're deluging people with lots of information that kind of sort of might be useful, but only a tiny percentage of it is. If we could teach common sense, I'd be really rich.
I've got very low standards as well, as long as I'm kept out of jail, right? That's a big part of what I do. I've got a great team of analysts who spend their time doing investigations for potential terrorist financing. My measure of success is when we find, we'll say, high-quality files where we've reported, and we've done that directly to, say, CSIS. We get acknowledgments back that as a result of that, they've opened investigations. To me, that's a measure of success. You'll never hear back that, oh, we caught these bad guys, or we've prevented a bombing or some. In very, very rare circumstances, I know I've got some peers who have been awarded civilian citations, but I'm not looking for that. But I am looking for high-quality files that are anomalous, but they do represent, at least in our view, something that is troubling.
No, I agree with that. The only measure of success is the what if. What did we prevent? What did we prevent, not just in terms of outcomes, but in terms of the consequences for our own firm, for our colleagues, for our clients, for our suppliers, and so on. But it is difficult, and I grant you. I come from a product and a strategy background, and you can measure success positively. And it seems to me that in the compliance industry, in contrast, people are motivated by fear. They're motivated by fear, above all, of auditors and examiners. And extracting the positive is something that we, and frankly our regulators, need to focus much more on. At the same time, we need to promote, however you define this, but ethical modes of behavior. And that is very, very hard to do when your resources are living in a culture of fear, effectively being held to account for the actions or inactions of their colleagues in an environment where, formally speaking, you can only fail. And I agree with you when it comes to the measures of success, but those things need to be systemized, need to be operationalized, and need to be recognized by the regulatory and the audit community for that to take root. And I think that'll take many years.
Somebody asking the question, so when you can't fulfill both privacy laws and AML, CTF laws, which one do you choose to break?
Do I want to be fried or boiled? Well,
that's for almost everybody.
Look,
I don't want to answer that question.
It's a false choice, isn't it? I mean, it's a false choice. You should, in the way that you design your products and processes, anticipate situations in which that information will need to be shared. There are no privacy laws which cannot be overcome, whether we talk about GDPR, whether we talk about the Shield and so on and so forth, whether we think about contractual remedies to bank secrecy. If they are thought through and designed in advance. We hit that dilemma when we have not designed our processes, not designed our products properly, or where we wish to avail ourselves of legality in order to not to cooperate with, for example, a counterparty or an authority. So it's a false question. It means that we should be designing products and processes in such a way that we will not find ourselves in that dilemma.
Are we stopping the bad guys then?
In some ways, we'll never know. But I'll come back to something that Stephen said. When law enforcement or the government responds to one of our suspicious activity reports or one of our filings and says they've opened an investigation, they need more information, that's an indication of some measure of success. We need to make sure that we're reinforcing success. Mm-hmm. So don't just have the analyst walk on air for a couple of weeks after that because they realize that their work has been recognized. Really dissect it. Mm-hmm. What was different about that case to all the others that we filed? How can we leverage that to fine-tune what we do to make it more effective in the future?
I like to think we're effective, and we're playing our role. We're delivering information. We're creating typologies, but we can't become complacent. I mean, we have to be ever vigilant. I'm always thoughtful that if you're a terrorist, you're a criminal, you're a bad guy, you are going to be very smart. You're going to likely be a step ahead of me. So for me, just to rest on my laurels and say, oh yeah, okay, I think we're doing a fantastic job. We don't have to do anything else anymore. No, we have to constantly be evolving. We have to constantly change. We have to think of new typologies, new rules, new methods. And as we're seeing that, we're seeing different types of terrorist attacks because
one way you can
evolving.
Look at it is to flip on the other side. I think somebody mentioned this in our preparation call when they said, one way you can look at it is to say the fact that banks have been great at customer acceptance, have been great at monitoring transactions. It's where you've now seen this change in the type of attacks that have happened where increasingly terrorists can circumnavigate or circumvent the financial system altogether and walk into Hertz or any company and rent a car and conduct an attack.
It's got to be, if you look at how terrorism was financed traditionally, how it was financed in the 60s, how it was financed in the 70s, in the 80s, and the 90s, it is obvious that those MOs, those ways of financing terrorist organizations would not be possible today. Mm-hmm. So to that degree, we've been successful, and there has been a displacement. It has been quite simply impossible for ISIS to finance terrorist operations in Europe, in North America, in the way that Al-Qaeda was able to do 15 years ago, 20 years ago, in the way that the IRA was able to do, that the PLO was able to do, that the OAS was able to do, and so on and so forth. So, and indeed, the fact that you have these low-value attacks now is, in an ironic way, a measure of success, not just of banking CTF measures, but of course there's displacement. You have state actors who have sources of finance and abilities to extract funds through laundering or through theft or through both from the financial system in a way that current defenses, current frameworks are weakly adapted to addressing. So it's always going to be a moving target. But has it been successful? As someone who's not directly involved in sort of retail or cash payments business, particularly onshore, looking at it a little bit from the outside, I would have to say, yes, it has been dramatically successful, but it's never going to be sufficient.
I think we need to keep some perspective on it as well. I mean, this is a relatively new industry. 9/11 was a galvanizing event for the US. I would venture to suggest that many US bankers pre-9/11 didn't know what KYC stood for. So the spend that you talked about at the beginning is to a certain extent the evolution of standing up a completely new industry. We have a better awareness of risk now. Perhaps we all thought at one point that embassies could only be low risk. I don't think we think that way today. We scrutinize activity a lot more. We try and leverage what we do in the fraud space. I have friends who are quite alarmed when they get a phone call from the bank saying, are you trying to buy a TV in Chicago? But really, that's real-time monitoring, and maybe that's the direction we need to go in from an AML perspective.
Someone asking, it's hard to prevent lone wolf attacks beyond what's practically possible. So is the focus equally on recovery and backup solutions? I don't know. How would you interpret that question?
I think it's recovery from the situation. I mean, the lone wolf attack happens. You're then reconstructing the person's financial background to try and piece together the network that they worked within. And the bad guys are smart. They're well-resourced. They're well-motivated. Their incentives on the upside and the downside are much different from ours. They don't get a bonus at the end of the year if they did well. They get to live.
One other question, probably, Mark, why don't you start with this one? How important is it to get the beneficial ownership hierarchy of your clients verified from a third party?
Verified from a third party. It very much depends on the nature of the client, and then getting into the whole debate about enhanced due diligence and standardized due diligence and so on and so forth. But it is important to know who your client is. And paradoxically, I can name a case where the stringent application of KYC rules actually leads to unintended consequences. A problem in the securities markets in China, for example, where every individual investor has to be registered at the upper tier, so millions and millions of them, is what they call borrowed accounts. So, where basically you get your grandmother to open the account. So if the rules are too stringent, you end up with effectively, millions or at least hundreds of thousands of borrowed accounts. That's an example. But where I do think beneficial ownership is important is that right the way through the financial system, the identity of those who benefit from transactions, contracts, investment schemes, economically, are identified. All too often, we, as an industry, thread the needle between beneficial owner in the sense of the legal owner, beneficial owner in the sense of those who control, and beneficial owner in the sense of the name that is on the paper. And we struggle with this, and we come with more and more dense definitions. But what matters is who's benefiting from it. And any investment banks in the room, above all, please, if you do not focus on who's benefiting from a given transaction, then you are not doing the job, and you are just facilitating an easier world for the bad guys. But all too often, and you will have card-carrying law firms come in and say, no. Stephen's the beneficial owner. It's not Kavita. What are you thinking of? When it's absolutely obvious. If you apply, if you have a degree in common sense, that it's Kavita who's the beneficiary.
But I think that's the challenge, right? It's we ignore common sense so often, right?
Yeah.
I mean, I'm a lawyer for trade, and it's so often you're looking at just meeting the minimum legal requirements as specified by the regulations. I mean, we make our livings at that, like as a lawyer, but it doesn't get to the root of or the purpose of why we're actually doing this.
Yeah.
It's to actually get down to the individual and to understand who is actually benefiting.
I think we alluded to this in some of our discussions when we were talking about fintech not having the same regulations as the banking industry. Somebody asking, is the weight of compliance encouraging growth of non-bank financial vehicles and systems which are then outside the scope of official monitoring?
I think it is, because one of the things that fintech promises is to reduce friction. To some extent, the compliance obligations can be viewed as friction. It's hard to open my account here, but it's easy to open an arrangement there where I can move money. So I think if it walks like a duck and talks like a duck, it's got to be regulated like a duck.
Stephen, somebody's saying the US government is very aggressive on sanctions, including for terrorist financing, and some countries like the EU push back. What is the approach in Canada?
Canada is actually very aggressive. In some cases, when it comes to sanctions, we're actually more aggressive than the US government. If you look at initially the Russian and the Ukraine sanctions, Canada had more people and entities on the lists than the US had. So we can be quite conservative, but we tend to follow what the US does in many instances, right? When you look at Venezuela, for example, right? We finally have our own Magnitsky Law. It's not enforced yet, but so we're following suit. But I would say, Canada, we are very aligned actually to our big trading partners, being the US but also the EU.
And I'd like to get a sense from the audience. How many of you work, would you say, for large global banks? Show of hands. Okay, so not most people. How many
I'm
people
large.
would you say work for smaller institutions, smaller financial institutions? Okay, in developed countries, show of hands. Okay, and less developed countries. Okay, so that gives you a sense, because when I mentioned the cost and all the controls and the processes that are being put in place, obviously, you have bigger institutions, more global institutions that can afford that. They have the resources, or they have more to lose, so they're willing to spend the money on those resources. What happens in less developed countries to be able to bear the increasing cost of compliance?
Can we ask the audience if anybody's in fintech?
Fintech, anybody?
Hello.
One or two.
One.
So is that the symptom or is that the problem?
So in terms of, how could smaller institutions in less developed countries be able to bear that cost? Because it's a big list.
So one thing I equate this to, and one of the things that I found in my personal experience, it's particularly, we'll say, Canadian banks who've developed an infrastructure that's based on technology that was developed at, say, in the 1970s and 1980s. We've become these behemoths with legacy systems that actually become a constraint to integrate. It's actually more problematic, I think, if you are a bigger bank to some extent, especially if if you have systems in various jurisdictions. If you're just a startup, you kind of equate this maybe to the development of cell phone technology in developing countries where they didn't have landlines and you may not need them. You can skip that step and you could potentially run faster, and I think your costs could be lower than trying to integrate legacy systems.
And the system, the example people always use is M-Pesa in Kenya.
Yes.
That they didn't have anything like that in Africa, and now everybody is, doing payments through a mobile phone. And
When you think about how quickly the technology is evolving, the cost is borne almost equally by countries or companies all around the world. To the extent you don't have to do that integration, you can be saving significant amounts.
Yeah, I think one of the best ways is through cooperation, through communities. So from where I sit, securities, ICSD, very much like a correspondent bank in the sense that we have customers, regulated financial institutions from all over the world. And a couple of observations. Coming into the job, and I came from a product background, 3 or 4 years ago, I expected, obviously, bank in high-risk, corrupt country likely to be a problem. Bank in low-risk, developed country, part of a global group, unlikely to be a problem. Well, first observation, wrong. Absolutely wrong. Very often, the second bank would have an ambivalent attitude, one that was legalistic, one that was everything that we've said, if you like, on the negative side about, complying to the letter and leaving common sense at home when you catch the train in the morning. Not so in the emerging markets. In the emerging markets, you have a much better measure of success in terms of financial crime compliance, which is Do I still have an ICSD that will do business with me? Do I still have a New York-based correspondent that will do business with me? Because if I don't have those things, I am dead. And consequently, the sheer recognition of the value of a risk-based and outcomes-based approach is much firmer. In terms of the costs of compliance, then a lot of the work that we are doing as a community, whether it is the KYC registry of SWIFT, whether it is things like communal screening solutions, and whether it is by articulating due diligence frameworks. Tracy was talking to us about the Wolfsburg DDQ yesterday. At ESA, we have the securities DDQ. I understand people in the trade space are beginning to think in the same way. Then we are saying to those who participate in the capital markets from out there in the network, these are the rules of the road. These are the things you need to do. We're getting much better at articulating expectations. 10 years ago, banks would not go to their customers and say, these are expectations, for fear of embedded liability. If I tell you, don't deal with this sanctions guy, then they're going to rely on me, and if I fail to tell them tomorrow, then I'm going to be liable, so I'm going to tell them nothing. That attitude still exists, but it's becoming much, much less common. So those are the ways in which I hope we're making the costs of compliance better. But what we can learn from those banks is the importance of a risk-based approach, the importance of an outcomes-based approach.
And I think coming back to the question, it's not where the bank is, it's the resources that the bank is willing to put into it. Because we see enforcement actions against banks in the EU, against banks in the US that have chosen not to allocate resources to compliance, and they've got themselves into trouble. Equally, we see that in lesser developed countries where it may not have been a matter of simple choice, or just availability of resources.
Somebody asking a question here. Other than avoiding compliance fines, are you aware of any programs around the world that reward banks for identifying money launderers and terrorist financiers? I think it's a great question.
Yeah, I mean, FinCEN publishes periodically acknowledgements. They don't name the banks, but they publicize, I think, the top 20 cases that were successful. I guarantee that if any of your staff worked on any of those cases, they know who they are. They are absolutely thrilled.
Yeah. Do banks push back on regulators and those making new regulations to make sure measures are really effective, or is everyone too scared to do that?
I can comment. There are lobby groups, right? Whether it's like the Canadian Bankers Association, the American Bankers Association. There's lobbying that goes on. Attempts are made, I believe, with the lawmakers to make sure that they are drafting legislation that makes sense, that's workable, that actually achieves the desired goals. It's not always successful. I know we butt heads with regulators on examinations quite frequently, in part explaining a risk-based approach rather than just being an exercise in quantitative analysis. It's challenging, though. I mean, quite frankly, the regulators are in a power position, so it's difficult to argue.
So the industry associations have a role to play here, because the industry associations offer a way to the banks to push back on a no-name basis. So I'm privileged to be one of my bank's representatives of the Wolfsburg Group, and we engage very heavily with FATF, with the Basel Committee, in terms of trying to shape guidance and advocate for the industry.
Okay, last question, 30 seconds each, if you may. CTF, are we catching the bad guys? What are the main takeaways that if anybody leaves this room today, what are the key things they should take with them as they go? Alan, let's start with you.
Reinforce success. Identify where you get positive feedback and try and figure out how to replicate that. I think we probably are stopping some of it. We'll never stop all of it.
Yeah, we stop some of it. Allocate resources. That's the most important thing. Don't ignore it. It's in a separate area from AML, different types of investigations. you may not have a lot of budget to be able to allocate towards it. There's an expectation that you're doing something, though, so please do something.
We've closed a large number of channels. Charities, we have shut down a lot of the traditional avenues of funding. The new avenues of funding are emerging. They'll always be emerging. We must respond to that. And I take issue, I don't think at that level that CTF and AML are different disciplines. But we need to remain alive to the fact that these things are changing. And in particular, we need to watch the state-sponsored space in the intersection of cyber and also of virtual currencies and other forms of virtual asset.
Panel, nice to have you all with us. Give them a warm round of applause to Alan, Stephen, and Mark. And thanks to all of you. Thanks
Thank
very
you.
much, everybody.